All right, welcome back to another deep dive. Today, we're taking a massive player in the mining sector and putting it through the absolute ringer. We're looking at Teck Resources. And to figure out its true intrinsic value, we're not just glancing at a simple price-to-earnings ratio and calling it a day. No way. We're running this stock through the ultimate valuation gauntlet. Literally a massive 21-model financial stress test. We're going to strip away all the market noise, look right past those shiny headline earnings, and use the raw data to see what this business is actually worth underneath it all. So, if you're wondering whether this commodity giant is a hidden gem or a total value trap, you are in the exact right place.
Okay, let's dive into this. Here's our roadmap for today's explainer. First, the setup. Second, we'll hit the 7 hidden red flags. Third, the overlooked green flags. Fourth, we'll run the legendary investor test. And finally, we'll wrap it all up with the final verdict.
Starting right off with Section 1, the setup, looking at our base data and models. Let's start by establishing the sheer scale of the financial data we're tackling here. The foundation of any solid valuation is knowing exactly where the market is pricing the asset right now versus what the math says it should actually be worth. So right out of the gate, let's establish the stakes. Our comprehensive analysis gives us an average intrinsic value range of $58 to $82 per share. Now compare that to its current trading price of $63.53. Just looking at that spread, Teck Resources looks, well, fairly valued to maybe slightly undervalued. It's sitting comfortably in the lower half of our intrinsic value range, which immediately hints that we might have a decent margin of safety here. But averages can be kind of deceiving, right? So we really need to look under the hood. And here is exactly how we got that average. We ran 21 distinct valuation models and broke them down into 5 main groups. Group A focuses on cash flow and DCF models, and those cluster quite a bit higher, around the $68 to $90 mark, mostly because they're heavily driven by expected copper growth. Group C, our comparables and multiples, also points toward it being undervalued. But take a look at Group B, the dividend and income models. Teck pays this tiny token dividend of just 36 cents a year. Because of that, these dividend discount models are churning out unbelievably conservative values. We're talking some as low as $4 to $12. And that is aggressively dragging our overall average down. Meanwhile, Group D looks at the asset-based book value, and Group E factors in the massive option value of the impending Anglo-American merger. Moving right along to Section 2, 7 hidden red flags. This is the bear case. Now that we have our baseline, we've got to stress test it. It's time to pivot and look at the bear case, uncovering the 7 hidden red flags that the financial media seems to be totally ignoring right now. Headlines absolutely love hyping up Teck's recent 415% year-over-year earnings beat, but let's look at the actual raw data. First off, the return on invested capital, or ROIC, is a pretty dismal 8.78%. That is well below their 11.36% weighted average cost of capital. To put that in plain English, for every single dollar of capital Teck invests, they are actually destroying economic value. Ouch. Second, their free cash flow conversion is incredibly weak, just 26.5%, because massive capital expenditures are just gobbling up their cash. Third, look at this effective tax rate, 39.34%. That is a crushing burden on their profitability. Add in the fact that zinc production at their Red Dog mine is dropping. They just slashed zinc guidance at Antamina by 30%. There's a looming Chinese regulatory risk for that Anglo-American merger, and they carry a high beta of 1.59. Simply put, if copper price is correct, this stock is going to get hit, and hit hard. All right, Section 3, 7 overlooked green flags. Let's look at the bull case. So the bear case is very real, and it carries some heavy weight, but every coin has 2 sides, right? Let's shift gears and explore the defense's case. Now, what's really interesting about this slide is how the data completely redefines what Teck Resources actually is today. For years, Teck was known as a diversified miner, heavily relying on coal and zinc, but not anymore. Actually, scratch that. It's more like a total transformation. Surging production has totally flipped the script, and copper now completely dominates the business, making up 62% of their total revenue and a staggering 67% of their gross profit. In Q2 of 2026 alone, their copper production jumped 25%. They are riding the massive secular tailwind of the global energy transition, and copper is absolutely leading the charge. And that builds into a frankly undeniable bullish narrative. Let's start with their balance sheet. It's an absolute fortress, sitting on $6.05 billion, with over $10 billion in total liquidity. Meanwhile, as their production surges, their net cash costs for copper have dropped 19%, down to a highly efficient $1.64 per pound. That incredible efficiency generated record-adjusted EBITDA margins of 61%. 61%. And of course, we can't ignore the mammoth in the room, the $50 billion plus Anglo-American merger. That deal instantly creates a top 5 global copper producer. The market is definitely seeing this too. The stock is up 94% in the last 52 weeks, backed by heavy institutional support, sitting at over 74%. The bulls definitely have some serious ammunition here. Section 4 brings us to the ultimate boss fight, the legendary investor test. So we have this massive clash of extreme red flags and incredibly powerful green flags. To settle the score, we need to ground all this complex data by putting Teck through the specific, ruthless philosophies of 3 legendary investors. First up is the father of value investing himself, Ben Graham. He famously said, "You're right because your data and reasoning are right." Graham demands a wide margin of safety, and honestly, he would view Teck with extreme caution. His strict test demands a price-to-earnings ratio below 15, but Teck is currently sitting at a trailing PE of 17.72. Furthermore, when we calculated his famous Graham number, which is a metric combining earnings and book value, we got $57.36. With the stock trading around $63, it's sitting at a roughly 10% premium to Graham's absolute ceiling. So for a classic value investor, the safety net just isn't really there right now. Next, we bring in the champion of growth at a reasonable price, Peter Lynch. He famously noted that the PE ratio of any company that's fairly priced will equal its growth rate. And this brilliantly illustrates exactly why Peter Lynch would aggressively buy this stock. Teck's expected earnings growth for 2026 is projected to be way north of 20 to 25%. When you take that massive growth rate and compare it to its forward PE of just 16.27, you get a price to earnings to growth or PEG ratio of approximately 0.7. For Lynch, anything under a 1.0 is a screaming buy. The growth here just far outpaces the price multiple. Finally, we face the Oracle of Omaha, Warren Buffett, who prioritizes high-quality compounders above all else. His mantra? It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So does Teck pass the Buffett test? Well, despite having a pristine net cash balance sheet and generating a really attractive 7.2% owner's earnings yield, Buffett would actually pass on this stock. Why? Remember that glaring red flag we talked about earlier, the dismal return on invested capital of 8.78% alongside a return on equity of 8.72% completely fails his strict 15% quality thresholds. To Buffett, Teck is just a fair company at a fair price. It's not a wonderful one. Which brings us to our final section, Part 5, the final verdict. We've run the gauntlet. We've seen the models, we've weighed the red and green flags, and we've consulted the legends. Now it's time for our final synthesis to deliver on this explainer's ultimate promise. Before we stamp a final price on it, we have to understand its structural defense. Teck possesses what Morningstar would classify as a narrow moat. It absolutely nails efficient scale by being a top 10 copper producer with assets that are just incredibly expensive for anyone else to try and replicate. It also boasts a serious cost advantage, specifically thanks to the incredibly low-cost operations down at Quebrada Blanca. However, at the end of the day, mining is fundamentally a commoditized business. Because of that, Teck lacks intangible brand pricing power. There are zero switching costs for buyers and absolutely no network effects. It's a strong moat based entirely on scale and cost, but it remains narrow because of the unpredictable nature of the commodity cycle. So the crucial point is this: when we blend all 21 of our models together and we discount that unrealistic dividend drag we talked about, we arrive at a true blended fair value of between $68 and $72 per share. At its current price, you're looking at roughly a 5 to 15% discount. This makes Teck Resources a classic cyclical growth story trading at a very reasonable price. But remember, the market has already priced in a lot of that Anglo-American merger premium, and that inherent commodity cyclicality leaves very little room for error if copper prices happen to pull back. It's a fascinating standoff, isn't it? We have Peter Lynch's incredible 0.7 PEG ratio screaming "buy the growth," actively fighting against Warren Buffett's strict quality metrics, warning us to wait for better capital efficiency. The structural upside of the copper transition is undeniably massive, but the capital-intensive, cyclical reality of mining is constantly dragging it down. The numbers say buy, but the quality says wait. So which side are you on? Review this data, do your own homework, and let us know where you land in the discussion below, keeping it respectful and following community guidelines, of course. Thanks for joining us for this explainer, and we'll see you in the next one.